126 United States dollars per barrel. That is not a forecast from a perma bear or a headline designed to sell newspapers in Raffles Place. That is the forensic stress test number for Brent crude oil if the Strait of Hormuz remains effectively locked through the third quarter of 2026. Most investors in Singapore are looking at the Straits Times Index breaching 5,000 points and thinking the coast is clear. They see the green numbers on their banking apps and assume the recovery is structural. But they are missing the physical tension at the water's edge. When 20 million barrels of oil per day, nearly 20% of global supply, is erased from the ledger, the ripple effect does not just stay in the Middle East. It travels through the natural gas pipelines that power 95% of Singapore's electricity. It sits at the table with you at the Bedok South Market and Food Centre when the price of a bowl of fishball noodles inches up because the vendor's utility bill just spiked by 12%. For a retail investor in Singapore, managing a CPF or SRS portfolio, this is not just a geopolitical event. It is a direct rate on your purchasing power and your dividend safety. Welcome to The Pit. I'm Iggy, your guide through the Singapore market jungle, where 6,000 plus of us run the forensic numbers before mainstream media catches on. In this market, the entry window on a sanctuary stock doesn't stay open long. By the time the free version drops, the setup has already played out and the price has already moved. Iggy's elite investors get zero-day access to every forensic breakdown the moment it's finalized. Full 5-layer audit, hard numbers, no corporate hype. All in for $9 a month, less than a Ya Kun set. Act on the analysis when it still matters. Now let's get into today's numbers. If you are 55 years old and living in Marine Parade, planning your drawdown strategy, you need to understand that the risk-free benchmark has shifted. We are here to audit the receipts today because the consensus narrative is lulling people into a false sense of security. We are going to look past the 5,000 point milestone and stare directly at the debt wall and the organic net property income of the companies you own. By the end of this analysis, we will answer one uncomfortable question. Is your current portfolio yield actually high enough to outrun an energy-driven inflation spike? Or are you holding a yield trap that is about to hit a brick wall? We start with the frontline casualty of any energy crisis, SIA. The raw data tells a story of two halves. On one hand, SIA is coming off a period of record profitability with a cash hoard that looks like a fortress. However, the forensic reality is that fuel typically accounts for 30 to 40% of an airline's operating costs. Currently, SIA is managing jet fuel costs against a Brent baseline of approximately 102 United States dollars per barrel. But in our forensic stress scenario, where the strait remains gated, we are looking at jet fuel prices projecting toward 150 United States dollars per barrel equivalent. This is not a minor fluctuation. It is a structural doubling of the single largest expense line on the balance sheet. What does this actually mean in plain terms? It means the record profits everyone is talking about are backward looking. They are a reflection of a world where fuel was cheap and travel demand was inelastic. If jet fuel stays at these elevated levels, the margin headroom that supports the current dividend yield will evaporate. An airline is essentially a giant machine that turns fuel into cash flow. When the cost of that fuel doubles, the machine has to run twice as hard just to stand still. For a 60-year-old investor in Jurong West who moved a portion of their SRS funds into SIA for the recovery play, the consequence is visceral. You are not just betting on more people flying to Tokyo or London. You are betting that the airline can pass on a massive Hormuz surcharge to passengers who are already feeling the squeeze on their own wallets. If they cannot, that dividend you were counting on to fund your retirement lifestyle becomes the first thing the board of directors will cut to protect the balance sheet. This is the difference between a blue chip and a forensic sanctuary. Now let us look at the kopitiam counter argument. You will hear some uncles at the coffee shop saying, SIA is the national carrier, they have the best hedges in the business, and everyone still wants to travel. That sounds logical on the surface. But let us run the numbers. Even a world-class hedging program only delays the inevitable if the price shift is structural rather than cyclical. If the Ras Laffan complex disruption lasts 5 years, your 12-month hedges are just a slow-motion car crash. The forensic verdict is that while SIA has a strong balance sheet today, it is currently a watch list trigger because the fuel margin squeeze in the bear case scenario represents a clear and present danger to distribution sustainability. We move from the skies to the warehouses. MLT is often cited as the gold standard for industrial exposure in Asia, but the raw data reveals a widening crack in the foundation. The trust's total liabilities have climbed to 6.67 billion Singapore dollars, a 5.13% increase over the previous year. More importantly, the most recent quarterly revenue has softened to 176.8 million Singapore dollars, down from over 182 million a year prior. When your debt is going up and your revenue is going down, you are watching a pincer movement close in on your distributions. What this means in plain terms is that the organic growth narrative is hitting a wall. A REIT grows by raising rents or buying new buildings, but when interest rates remain sticky and energy costs drive up the operating expenses of your tenants, your ability to hike rents disappears. If you are a 55-year-old investor in Punggol, using your SRS to hold MLT for stable income, the consequence is immediate. Your distribution per unit has already shown signs of contraction, dropping from over 2 cents to a recent 1.82 cents. That might seem like a small number, but for someone depending on that cash flow to supplement their CPF payouts, that represents a 10% pay cut from a supposedly safe asset. If the fuel crisis forces a further increase in the Singapore Overnight Rate Average, or SORA, verify, MLT's cost of debt will rise just as its tenants reach their breaking point. The kopitiam counter argument here is one you will hear often. Logistics is the backbone of e-commerce, and people will always need warehouses. While that is true, the forensic verdict is that you cannot eat strategic importance. You eat cash flow. If the cost of servicing $6.67 billion in debt rises faster than the rent collected, the unit holder pays the price. Investing Pro currently prices MLT's fair value at $1.33 Singapore cents against a current market price of $1.16. Which means the unit is actually trading at a 14.7% discount to fair value. That is not a green light. That discount exists because the market has already priced in the debt to revenue divergence. The forensic picture suggests that MLT sits in watchlist territory until the gearing trajectory reverses and revenue growth resumes. To survive this energy-driven reset, we must apply the Iggy forensic floor. This is our line in the sand. We take the 3.2% forensic floor and add a 150 basis point risk premium to account for the current geopolitical volatility. This gives us a minimum yield hurdle of 4.7%. Any asset in your portfolio yielding less than 4.7% is failing to compensate you for the risk of capital erosion. The 6-month Singapore T-bill is currently yielding 1.37% based on the latest BS 261058 auction on 12 March 2026. Compared with approximately 1.36% at the previous auction in late February. The direction of travel is upward, but the level remains well below our 3.2% forensic floor. When T-bill yields move in this direction, it is the market's early warning system signaling that inflation expectations are shifting. But here is the uncomfortable truth. Even at 1.37%, T-bills are a sanctuary for liquidity, not a vehicle for wealth. They do not even clear our forensic floor. This means the only true sanctuary for a Singaporean investor remains the CPF special account at 4%. Let us narrate a compounding illustration for an investor holding a basket of SGX banks and REITs today. If you have $100,000 invested at a 5% yield, just barely clearing our hurdle, and you reinvest those dividends, after 1 year, you have $5,000 in additional capital. In year 2, that $5,000 earns its own return, bringing your total passive income to $5,250. Over 5 years, your original $100,000 grows to over $127,600 through the sheer force of math. But, and this is the forensic but, this only works if the distribution is organic. If the company is borrowing money to pay you that dividend, or if rising energy costs eat the margin, that 5% yield becomes a 3% yield and your compounding engine stalls out. In a world of $126 oil stress scenario, only companies with fortress balance sheets and genuine pricing power can keep that engine running. We open with a question: is your current portfolio yield high enough to outrun an energy-driven inflation spike? The forensic verdict is a resounding no for the majority of traditional income stocks on the SGX. The numbers do not support the narrative of the STI at 4,904 points, as of the 25th of March, being a safe entry into energy-sensitive sectors. When we look at the divergence between rising T-bill yields and softening REIT distributions, the data shows that the risk-adjusted return across those pockets of the market is actually shrinking. The gate at Hormuz is not just locking in oil, it is locking out the easy gains of the last decade. The only way to win is to demand a higher yield hurdle and retreat to the sanctuary of the CPF special account for your core defensive bucket. The energy crisis of 2026 has fundamentally changed the rules of the game. You cannot rely on the blue chip labels of the past to protect your future. A company that was a dividend king when oil was $60 is a jester when oil is $120. Consider a 60-year-old in Jurong West managing his SRS drawdown today. He is facing a reality where his utility bill is rising twice as fast as his bank dividends. This is the forensic tension of our time. Will you wait for the next quarterly report to confirm what the energy markets are already telling you? For the full forensic breakdown, the data tables on the debt wall, and the interactive sector watch, follow the link to the Substack article in the description below. Join Iggy's elite investors for 0-day access to these dossiers. The gate is locked. Make sure you have the right key. This content is produced for educational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing